Okay, I think there's quite a few questions in here. I don't think your tutor answered all of them. I'll do my best to answer as much as I can, and we'll go from there. This is question 3 for us. So disposable income is equal to personal income minus personal tax payments. That's A. B, personal income minus government transfer payments. C, the income households have to consume, save, and pay taxes. D, personal income minus social security benefits. And this is just about knowing the definition of disposable income, and the answer should be A. Let's see what our tutor said. Disposable income equals personal income minus personal tax. So we can just write that down for now, in case you might want to write that down. Am I spelling disposable right? Yeah, I am. Disposable income. This is disposable personal income. That's a key word right there. Disposable personal income equals personal income minus personal tax payments. Probably didn't need to write that down because it's here. So anyways, disposable income is equal to disposable personal income is equal to personal income minus personal tax payments. Question 2, 47 here says when one producer can create a given amount of output with fewer inputs, what exists? A, comparative advantage. B, comparative disadvantage. C, absolute advantage. D, absolute disadvantage. So let's just write the definition of these first. Call comparative advantage CA equals when a country can produce a good more efficiently than another. When a country could produce a good more efficiently than another, you would say that country has a comparative advantage over the other. And comparative disadvantage would be the exact opposite. If a country produces a good less efficiently than another, then they have a comparative disadvantage over that, towards that other country. And then we'll call absolute advantage AA. And this is just when a country can produce a good at lower costs than another. So basically, the difference here is just because a country could produce a good at lower cost than another doesn't mean they have a comparative advantage. They have an absolute advantage, but it just means that maybe the country is more developed. They might be a first world country, whereas the other country being compared to them is a third world country. So they're just more developed. So the question says, when one producer can create a given amount of output with fewer inputs, what exists? And we would say this should be A as well, comparative advantage, because that just speaks on efficiency. Let's see what our tutor said. A, comparative advantage is that a producer can produce at a lower opportunity cost than others. So, yeah, that is A. So we can take out this definitions over here. Forty 48. Given a country has 167 million, so let's just write this down as we go. With a labor force of 102 million, 73.5 people are employed full-time. $16.2 are employed part-time. Try to write 16 there. I would say employed part-time, say that's 16.2. 5.5 are discouraged workers. I think this is better looking 3. And 12 million are underage. What is the country's unemployment? And our tutor says here, unemployment equals unemployed minus the civilian labor force. To find out the number of people that are unemployed, you just subtract everything from 167, like he or she did over here. 167 minus 73.5, 116 minus 16.2 minus 5.5 minus 12 million. You have 59.8 as the unemployed. And if the UR, unemployment rate, equals U over LF, equals 59.8 over labor force is 102. Don't have a calculator, but I believe that's correct. Actually, no, I'm lying. I do have a calculator. Yes, it is 58.6 to 0.63%. So 58.6%. That is correct. So next question should be 48, I believe. 48, the supply curve is upward sloping because as price increases, so do costs. As price increases, the consumer demands less. As price increases, suppliers can earn higher levels of profit and justify higher marginal costs to produce more. And D, all of the above. So right away we know it's not D, all of the above, because of option B over here. As price increases, consumer demand is less. And that's not talking about the supply curve at all. That's just talking about the demand curve. So we can scratch out B. This is kind of what the supply curves looks like. P and QS, quantity supplied. So as price increases, so do costs. That could be true. I don't think that's why costs increase, because price increases. I would say price increases because cost increases. So I would say A is not really a complete answer. So that leaves us with C. As price increases, suppliers can earn higher levels of profit. And as price increases, they're supplying more. Price multiplied by quantity supplied would be their revenue. So P multiplied by Q. And if P is being multiplied by Q, that equals revenue. As this graph goes up, total revenue should be increasing as well. Suppliers can earn higher levels, and it justifies a higher marginal cost to produce more. Because you're earning higher levels, it justifies spending more to produce more, because you know it's gonna increase your revenue and eventually increase profit. So the answer there should be C. And let's see what our tutor said. He said it's C. And okay, so we're at question 50 out of 60 over here. I believe there's 60. 50, when a college student leaves town for the summer, the demand for meals in a local restaurant declines. This results in A, a decrease in equilibrium price as an increase in quantity, and an increase in quantity. B, an increase in equilibrium price and quantity. D, a decrease in equilibrium price and quantity. D, an increase in equilibrium price and decrease in quantity. And let's see what our tutor said. C, downward shift in the demand curve, therefore reduces both the equilibrium price and the quantity. Let's look at the question again. When college students leave town for the summer, the demand for meals at the local restaurant does decline. So that does make sense. It would decline, and because it has declined, just draw a demand curve over here. Just say this is supply. If demand was here when students leave and it decreases, demand would go here. Call this P, Q. Call this demand 1, demand 2, and S. So we said it's C, decrease in equilibrium price and quantity, because it causes a shift in demand. Equilibrium price goes from over here, call this P1, to P2. That shows the decrease. And equilibrium quantity, Q2, goes from here, Q1, to Q2, and that's also decreasing. So we can be sure that C is the correct answer, a decrease in equilibrium quantity and price. Question 51. All the following shift the demand curve for automobiles to the right except for the local factory gives a big raise to its employees. A new brand of automobile dealership opens in town. The price of gasoline falls. D, none of the above. 51. C. Thus, when the price of gasoline falls, the cost of consuming automobiles decreases the demand. Again, let's read this. All the following shift the demand curve for automobiles to the right except for C. The price of gasoline falls. A new brand of automobile dealership opens in town. That shifts it to the right. A local factory gives a big raise to its employees. You could argue that shifts it to the right because it creates that makes the employees happy and want to do their job better to sell more cars. That doesn't really decrease the demand curve. Price of gasoline falls. I would say the right answer here is A and not C. All the following shift the demand curve for automobiles to the right, except for A. Yeah, except for A. Because price of gasoline falling, depends. People might want to buy more cars, and because gas is cheaper, it makes purchasing a car more worth it. B, a new brand for automobile dealerships opens up in town. That's more supply of automobiles. People have more choices, and demand could go up. A local factory gives a big raise to its employees. Yeah, I don't know if I agree with that. I think it's A. So I think the answer should be A, because giving a raise to your employees has nothing to do with the demand curve. So 51 we don't agree with. 52. Judgments about what ought to be in economics matters can't be proven false based on macroeconomics, positive economics, normative economics, and D, microeconomics. So this question is basically just asking if this is a positive or normative statement. And basically, I believe it's C. Normative statements usually have words like would, should, ought to be, could. And positive statements would be more direct, saying it will, it causes this, etc. And the key thing here is what ought to be. And that tells you it's a normative statement. So it would say this is C, normative economics. And I believe our tutor also said normative economics. Normative economics is part of economics that expresses value or normative judgments about economic fairness or what the outcome of the economy or the objectives of public policy should be. Again, this is a key word here, should be. Should. So we do agree that 52 is C. They didn't answer question 53, but let's take a look at question 53 anyways. Total output. Total real output can be determined by A, multiplying the total hours of work times labor productivity. B, multiplying total wages paid times output per hour of work. C, dividing total wages paid by labor productivity. D, dividing total hours of work by labor productivity. And I believe the correct answer here is A, and it's just about, again, knowing the definition. And labor productivity is measured by output per hour of work. So output is found as the product of work hours and productivity. And since productivity is measured by the number of hours worked, real output would be a product of those work hours and productivity. So we'd say that's A. 54, an economic condition in which rising prices and unemployment occur at the same time is called A, cost push inflation, B, demand pull inflation, C, stagflation, D, deflation. So correct answer here should be stagflation. It's 54. The tutor said it's stagflation, and that's just the definition. It's a definition question. But cost push, just to give you the definition, cost push inflation equals prices rise due to costs of production rising demand pull inflation would be prices rise due to excess demand, basically. So there's just a large deal of demand that if you increase prices, might not take, it will reduce some of those demands, but your profit will still go up. And deflation is just prices decrease. So if you didn't know the definition of stagflation, by process of elimination, cost plus inflation, by process of elimination, it would be stagflation for this. But stagflation is an economic condition in which prices rises as unemployment rises also. So that's 54. See how we're doing for time. So they stopped at 54. I'm also going to stop at 54 because we still have a lot more questions to go through. And I only have this session for 1 hour. So let's say most are correct. Great explanation. And the one we didn't agree with was, I believe, question 51. Most are correct. Great explanation. Solution correct.